Okay, here we have another asset, and we see in this example that we bought this asset in 2005 for R1 million and sold it recently for 6 million. So our profit was 5 million rand. What if this had been a primary residence? All we need to do is change the type of asset is to select the primary residence button here. We can immediately see that the amount going towards capital gains tax has dropped from 5 million to 3 million. This, of course, is because the profit on a primary residence sale qualifies for a 2 million rand exemption. If the selling price was less than 2 million rand, then capital gains tax does not apply at all, and this is an important thing to remember. Also, with the community of property primary residence, the exemption of 2 million applies to the profit on the property, and the remainder is split 50-50 between spouses who each qualify for a 40,000 rand annual exclusion. The primary residence exclusion is per property, remember, and not per spouse married in community of property. The summary window shows that the code 4250 amount that SARS wants you to enter on the ITR 12 is the full 5 million rand profit. SARS will apply any exclusions and community of property splits, etc. The program has done all that for us. Subtracted the 2 million rand primary residence exclusion, subtracted the 40,000 rand annual exclusion, and worked out that 40% of the balance, or 1.184 million, will be added to the rest of the taxpayer's income to be taxed at normal rates. Now let's discuss partnerships, and I'm not talking about a community of property splits here. I'm talking about actual partnerships owning an asset. We can use this very example on the screen here. What if 5 young people come out of varsity and buy a house together? They all live together in the house and it is their primary residence. They each have a 20% share. What happens when they sell the house one day? Who gets what share of the 2 million rand exclusion and who pays what share of the capital gain? Well, the program does everything for you. The law says that each person who has a financial share in the asset shares in the 2 million rand exclusion and shares in the gain for capital gains tax. This means that each partner winds up with a 20% share of the 3 million rand gain. If this particular partner we're concerned with here was married in community of property, then his 600,000 rand gain amount would be split between him and his wife equally. Now I just want to change the partnership back to 100%. I've also changed the price. The purchase price that we paid for this, I've changed it to 2 million, and I've changed the selling price to 2.6 million. Okay, we have no gain because of the 2 million rand exemption on the profit of a primary residence. The profit is only 600,000 in this case, and the 2 million rand exemption means there's nothing in the profit to go for capital gains tax. I just want to draw your attention to this field here where we can enter the size of the property. I'm going to enter a size of 3 hectares and see what happens to the gain. Suddenly we have a gain of 200,000 rand. Why? Well, the law regarding the 2 million rand exemption on the profit of a primary residence says the 2 million rand primary residence exclusion applies to so much of the property as does not exceed 2 hectares. Because this property was 3 hectares in size, it means 200,000 rand profit per hectare. The 2 million rand exemption applies to the profit on the first and second hectares, but the 200,000 rand profit on the third hectare stands on its own and is liable for capital gains tax. Here we have a primary residence which we bought in 2005 for R1 million and sold recently for 2.5 million. With a profit of 1.5 million and a primary residence exclusion of 2 million, we would expect zero capital gain. But we can see a capital gain of 150,000. You see, with the residency period in the equation, the primary residence exclusion pretty much goes out of the window unless the residency percentage multiplied by the profit exceeds the primary residence exclusion. In this case, 90% of the 1.5 million profit is 1.35 million, which is less than the 2 million primary residence exclusion. This means that we ignore the primary residence exclusion, and the amount for capital gain is the non-residency period of 10% of our profit of 1.5 million. Maybe what happened in this particular case is that we rented out 10% of the house and we had residency of 90% of the house. Maybe we even rented out 10% of our house to our private business while we lived in the other 90% of the property. Anyway, you can see here that our gain amount is 10% of the 1.5 million profit. So our amount for capital gain is 150,000 Rand. Let's have a look at a case where we made a bigger profit. I will change the sale price to 32 million. Here you can see that the residency period of 90% times the profit of 31 million is more than the 2 million Rand primary residence exclusion. So our capital gain is the profit of 31 million less the 2 million Rand primary residence exclusion as normal. Only when the residency period percentage times the profit is less than the 2 million Rand primary residence exclusion does the 2 million Rand exclusion fall away, and our amount for capital gain is the non-residency period percentage of the profit. Now I've changed the selling price back to 2.5 million. With our selling price back to 2.5 million, let's recap. We can see we had residence for 90% of the time and we were non-resident for 10% of the time. If 90% of the profit was less than the 2 million Rand primary residence exclusion, and we can see that 90% of 1.5 million profit is less than the 2 million, then we ignore the primary residence exclusion and our gain is 10% non-residency period of the profit, which is 150,000 Rand.